when economic activity drops sharply, broadly, and stays low for an extended period. We call that a recession. 2 consecutive quarters of negative growth in the gross domestic product, GDP, are often used as a rough indicator of a recession, though more complex formulas are also in use. When a recession is imminent, profits drop and growth goes negative, increasing the likelihood that the stock market will follow suit. Investors in stocks need to exercise extra caution during a recession because there is a good chance their holdings will lose value. However, it's hard to predict when a recession will hit, and there are better strategies than selling into a declining market. Most financial experts agree that in the face of a recession, investors should keep their eye on the long haul and view stock price drops as a chance to buy cheap shares. Join us as we explore what to do and what not to do with your finances in an economic recession. Stick around. Who knows, this might be your chance to get rich. What do you stand to gain from a recession? As a matter of course, economic downturns have knock-on effects across the board in the stock, bond, and currency markets. While it's unrealistic to count on making money during a recession, there are some bright spots. Higher interest rates at the start of a recession could help you earn more on your savings deposits, while lower rates as the recession ends could help you get a mortgage with better terms. After an asset's value has dropped, you can purchase it at a lower price. For investors like Warren Buffett, there is much more to gain from buying stocks at their lowest. While others focus on the short-term profits to be made, real investors take control of the market and make it a gold mine. There are 2 types of investments you can consider. Dollar cost averaging. Investing a set amount of money regularly, regardless of fluctuations in the share price, is known as dollar cost averaging. It can help you become a more disciplined investor, streamline your investment process, and reduce stress and financial outlay. Take, for example, a $100 monthly investment. In a rising market, $100 will buy you fewer shares than in a falling market, and vice versa. This tactic can reduce your average cost per share over time, as opposed to if you had purchased all of your shares at once when they were more expensive than average. It's easy to get distracted and end up spending the money you intend to put toward investments on something else, even though you know you should not be doing it. Regular, automatic contributions can help you develop investing discipline and stay the course when saving for the future, and that's one reason why people opt for this kind of investment. Almost no one, not even the most experienced investors, can successfully time the market or predict when it will reach its peak or bottom, so they can make purchases or sales at the optimal times. Dollar cost averaging helps ensure you'll be at the door when opportunity knocks. These recent events illustrate why it is essential to maintain a consistent approach to investing. People who stopped investing in the days before the results of the 2016 US election, when uncertainty drove markets downward, may have been left regretting their decision in the days after, when the market surged to record highs. Long-term investments. Investments made with a horizon of more than 10 years are considered long-term. Long-term investors are willing to take on more risk in exchange for the possibility of higher relative returns over the long term, because the effects of short-term price fluctuations are less severe over these time horizons. Closer to when they need the money, investors often shift their focus to safer investments. A person in their 40s planning to retire in their 60s may put a large portion of their savings into stocks, but may shift to holding more bonds as the retirement date draws closer. You should hold on to this investment style if you're going to make the most of the recession curve. Here are some guidelines for you to consider. 1. In the buy and hold investment strategy, investors make purchases and then keep their money in the market for the long term, regardless of short-term fluctuations. The goal of buy and hold investing, the most common and widely recommended approach for long-term investors, is to increase the value of one's investment over time. 2. Long-term investing with minimal trading is the cornerstone of the passive investing strategy. An index fund, either a mutual fund or an exchange-traded fund, ETF, tracks the performance of a specific benchmark index, such as the S&P 500, and is a popular choice for passive investors. 3. Taking an active role in one's financial portfolio is known as active investing. It can involve tasks such as market analysis, stock picking, and research. With active portfolio management, the goal is to achieve a specified absolute return or to outperform a predetermined benchmark, such as inflation or the S&P 500. How to identify the right investments. During a recession, it can be just as crucial for an investor to know what assets to avoid buying as it is to know which companies are good bets. Companies and highly leveraged, cyclical, or speculative investments pose the most significant risk during a recession. Pick businesses with lots of debt. Most investors avoid highly leveraged firms with massive debt loads during a recession. These businesses typically have an unmanageable debt-to-equity (DE) ratio because of excessive interest payments. In addition to having trouble making their debt payments, these businesses also suffer from a decline in revenue due to the economic downturn. Such firms are more likely to go bankrupt, or at the very least experience a dramatic decrease in shareholder value, than their less indebted counterparts. Cyclical stocks. Recessions are tough on cyclical stocks, often linked to employment and consumer confidence. When the economy is booming and people have more disposable income to spend on luxuries, cyclical stocks tend to do well. Companies that produce luxury goods, such as automobiles, furniture, and clothing, are good examples. The problem is that people tend to cut back on entertainment and dining out when the economy is terrible. They cut back on expenses like vacations and eating out. For this reason, cyclical stocks in these sectors tend to underperform and lose their appeal to investors in a down economy. Potentially risky stocks. Speculative stocks have a high market value because investors are optimistic about their future. This confidence is tested during economic downturns when these assets typically perform poorly. Investors looking to get in on the ground floor of the next ample investment opportunity often look to speculative stocks, which have not yet proven their value, as under-the-radar opportunities. These high-risk stocks typically fall the most rapidly during a recession as investors flee the market and seek safe haven investments to reduce risk during market turmoil. Recession-proof stocks. Although it may be tempting to avoid the stock market altogether during a recession, doing so could cause a person to miss out on great opportunities. There have always been businesses that thrived in bad economic times. A strategy based on counter-cyclical stocks with solid balance sheets in recession-proof industries could be a good option for investors. Robust financial statements. If you're looking for a company to invest in during a recession, one that can keep its finances in order or its business model stable despite the economic downturn is a good bet. Utilities, basic consumer goods behemoths, and defense stocks are all examples of the former. Expecting economic conditions to worsen, many investors increase their holdings in these sectors. Looking at its financial statements, you can tell if a company has manageable debt, positive cash flow, and is turning a profit. All of these should be taken into account before making any financial commitments. What industries are less affected by a downturn? Although it may surprise you, some sectors thrive during economic downturns. Stocks from these recession-proof sectors are popular for investors seeking a hedge against the market's downturn. Stocks with a low correlation to the overall market tend to do well during economic downturns because demand for them rises as incomes fall or as uncertainty increases. Typically, the share price of a counter-cyclical company will move in the opposite direction of the economy as a whole. These stocks tend to increase in price when the economy is in a downturn. They go down during an enlargement. Companies in the consumer staples, grocery, discount, firearms and ammunition, alcoholic beverage, cosmetics, and death care sectors tend to perform above average. Putting your money to work during recovery. After a recession has ended and the economy has begun to recover, investors should rethink their tactics. Interest rates are historically low and economic growth is robust. Companies that are highly leveraged, cyclical, and speculative, and that manage to weather the recession are the most successful. They are the first to recover as the economy returns to normal, reaping the rewards of rising confidence and hope. When market conditions are like this, counter-cyclical stocks typically underperform. Investors are shifting their focus to higher growth assets, putting downward pressure on these stocks. Which assets do best in a downturn? A recession has different effects on different types of assets. Staples, utilities, and other defensive stocks may do better if consumers return to basics. A strong balance sheet also means a company can weather a temporary profit drop better than a high-spending growth stock. When the economy contracts, bond prices can rise and interest rates can be lowered. Which stocks suffer the most during a downturn? Many growth stocks are unprepared for a downturn because they have weak balance sheets or high debt loads. This is because their profits may decrease due to reduced consumer spending, and they may have difficulty raising new capital if the economy continues to contract. When a recession hits, it's riskiest to invest in speculative stocks with weak fundamentals. In the long run, economic downturns consistently improve. Investors can participate in one of the biggest market booms while avoiding the turbulence that typically follows when the economy weakens by developing a strategy based on counter-cyclical stocks with solid balance sheets in recession-resistant industries. Those who can hold on to their investments through the current uncertainty will be rewarded in the long run. In addition, they might be able to cash out and reinvest the proceeds into more lucrative assets during the height of a bear market, setting themselves up for even more significant gains during the next bull market.